All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and today we got Andrew Kwok, principal at Arcus, the new shop, or should I say rebrand?
New shop, but a year new.
Wow, congratulations! But, yeah. I appreciate the swag bag you brought here.
Yeah,
you know what? I should show the camera the swag bag. All right, we got Arcus Capital. Can we see that? Can we see that? There we go.
Keep the breath fresh.
Yes, got to keep the breath fresh. Thanks again. You guys always are on top of it with the swag. You know, before with Capital One and B Street, you guys really keep the swag on point, and it's important.
The little things, man.
The little things.
It's the little things in general with branding. It's the little things in deals.
Yeah.
Especially now.
Yeah, I think you guys need to have some like decal stickers for some of like the older swag you got with different names. I just slap on the Arcus instead.
You know what's interesting is in our office when we were decorating, we realized that we had some leftover Beach Street OG Beach Street posters.
I kind of want that. I kind of want some OG gear.
We put the Beach Street posters. We had them framed. They look really nice. We have a kind of a informal conference room, and we put them up there just as a nod to kind of our background.
Yeah.
And, you know, when
and
we started
still have like, you know, the OG team, right? With like Tina and Greg and Kristen.
So our whole team, the four principals of Arcus Harbor, Greg Reed, Kristen Croxton, Tina Quirin, and myself have been working together. I'm like the short end of the stick. I think 18 years working with the three of them, and they're like 20, 25 years.
Wow.
So we go all the way back to Deutsche
same
Bank.
Team, different jersey, same team.
Yeah, and we've all held different roles at different times. Greg, Kristen, and myself have largely been on the production origination side, and Tina Quirin was actually our head of credit at Capital One. So we can unpack the whole story if you want.
I think we'll get to that. Yeah. You know, Kwok, just for the audience to know, you've been an awesome friend through business at this point, and we've done a lot together. Been in the game for a long time, over 10 billion of transactions and financing, agency, bridge to agency, all types of instruments. So definitely want to get into what you guys are busy with. I definitely want to also start on what you're seeing in the market. I saw this LinkedIn post you sent a couple days ago. I think you're on the board for the USC.
I think this is my
program?
Fourth or fifth year. I went to USC and wanted to get more involved several years ago, and had an opportunity to fight on.
My family's a Trojan family. I went to BU, so they were a little disappointed, but I still tailgate if I went to.
It's a great
SC,
school. Yeah,
and I think that's what matters.
You have no conflict either.
Yeah, exactly. No conflict. Exactly. My wife did go to UCLA, but you know what? She's not into sports anyway, so I could trick her to be a Trojan fan, and she'll be okay with it.
Yeah. So I sit on the board. It's I believe my fourth year. And it's probably about 75 people. You have the advisory board, the executive board, and then the kind of center members. Yeah. And it's comprised of about 75 people. And there's a portion of it that's networking, and then there's a portion of it that's thought leadership, talking about what the latest and greatest in commercial real estate is, what the latest trends are.
With other alumni or other?
Yeah, other alumni. And there are even some non-alumni on the board. But we sit there and we meet, I would say once a quarter, and we talk about the latest trends, and we bring in guest speakers. And the idea is to bring together thought leadership and leaders in the commercial real estate community in Southern California and drive what ultimately I think will be the curriculum for the real estate program at USC.
Yeah, and honestly, USC's their network is so strong.
It is.
I mean, I'm just like looking at other schools and their programs. Like everyone has great programs, but when you get out of the program, you start graduating. Like, wow, USC.
Yeah,
they're so interconnected, and it's that's a great place to be in. And one part of that is your post. You kind of had some key takeaways with some emojis. Yeah. U.S. economy strong, bond market volatility driven by lack of liquidity and lack of market participants, and kind of bonds as like the safe haven, private credit's on fire. So I want to unpack a little bit of that because
Sure.
I am seeing too that private credit's on fire. But you kind of had an interesting point of how it's basically on fire from also some of the bank regulations and deregulating. So what's like the boots on the ground of what you're seeing right now? Why is private credit on fire? And give me kind of your eyes and ears on what you're seeing out there.
I mean, to start with, I think you know this just as well as I do. There are so many debt funds and credit shops out there. Any private equity firm that has a focus on private credit and wants exposure to commercial real estate is participating in the private credit space for commercial real estate.
Yeah.
And it's growing. It's continued to grow. So you have all the private equity firms that invest equity and now credit into commercial real estate. And then you're starting to see operators, large operators that are starting to allocate dollars from their investors to credit strategy. Mm-hmm. So you take big names like True America, they're starting to look at credit positions, whether it's pref or mezz or senior loans. Some of the other bigger players that have been in it for a long time, Bridge Housing, they have a debt strategies team. Greystar has had a credit strategies team for quite a while. They started out by buying credit securities, and now they're full fledged. I think they raised upwards of $1 billion of equity, and if you lever that 2 to 3 times, that's $3 billion of dollars that they need to put out. And I think that's going out in the form of whole loans. And insert also regional shops that are looking at credit opportunities. So it's
I think part of it too is like a lot of this came when rates hiked and it was very lucrative to be in credit. You can get those kind of mid-teens IRR on being on a safer position of a stack. Yeah. And actually I'm in the middle of reading Ray Dalio's book, How Countries Go Broke, and he kind of says the same thing. Like when there is this rate hike period, you want to be on the credit side. And then as that kind of gets tighter, when yields get tighter, you want to be on the equity side. And so I think you're kind of seeing a little bit of that.
Yeah, definitely. I think you're seeing that. I also think you're, from your perspective, I'm sure it's very tough to find deals.
For sure. Yeah.
So if you
because our strategy as an operator, right? We're so management intensive, management focused.
Right.
And we're not taking bets on different parts of the stack. We're on the equity side and we're taking bets on different markets, different. So I think it's definitely an interesting strategy of how some of these, operators have a credit and they're placing credit in different parts of the stack on different deals.
Yeah. It's grown. It's continuing to grow. There's a lot of capital being put towards a credit strategy. And I think it's twofold. One, to your point, as interest rates have risen, being in a credit position is not a bad spot to be. Mm-hmm. The other is just a lack of deals in the market, or a lack of deal volume, or
that makes sense, right? That actually buyers and sellers meet.
Yeah. And so if you can go and generate mid-teens or even high teens, low 20s return from a credit strategy, I mean, it's not a bad position to be in. And what these guys are doing is they're taking, for every dollar of equity that they're raising, they'll go and borrow money from the banks at, call it 125 to 150 over SOFR, and borrow 2 to 3 times their equity and generate a healthy return, lending money at 300 to 350 over.
Yeah. So when, what I am seeing recently, I guess, through this first half of the year is now it's a little bit of a knife fight on the credit side, right? People are starting to race to the bottom, and there's a little bit more stability in the market than what there was a couple years ago. I feel like the shift is starting to turn a little bit out of credit into equity, but I would love to kind of hear what you're seeing as well. Is there still good returns on the credit side? Like, where have you felt like you've really had to stretch to like win deals now on the credit side? What are you kind of seeing out there?
Yeah, I mean, I think there's a lot of available capital but that capital is continuing to be fairly selective. And it varies.
Even on the credit side.
Even on the credit side. And it varies sometimes day by day. Appetite, whether there was a CLO that went out in the market, whether or not another fund has raised additional capital to allocate solely to credit. So as you're starting to see that, you know, I would say in the last 6 months, I have seen strong changes in appetite on the credit side. So let's just take a multifamily debt fund bridge loan right now. If you asked me 6 months ago, the majority of the shops were saying, we don't want to touch anything that's, you know, older than 2010 vintage. Then fast forward 30 to 60 days, it's 2000 vintage or newer. And it's like, okay, we like 90s vintage and newer. And it's just the pricing has also gotten more aggressive, but a lot of it just depends on the different players, who's just, you know, put out a CLO, who's freed up, you know, balance sheet capacity. So there's a lot of that's driving the decision making on the credit strategies.
Yeah, and I know. Listen, most of our listeners are pretty like savvy, but I think it's also interesting to talk a little bit about like how it's structured, like CLO. What does that mean? Like when you originate a bridge loan, what's happening in the back of the curtain? So maybe like briefly kind of touch on that.
Yeah. I mean, I think, you know, you have most debt funds. Most bridge loans that you're seeing today through a debt fund are reserving the right to sell the loan or securitize the loan. And a CLO is it's a collateralized loan obligation.
Right.
It's just a fancy term for saying CMBS for bridge loans.
Yeah.
It's a securitized product. They aggregate into pools and sell off different tranches to the bond market.
And they can sell the loan. They could sell part of the loan. Yeah, exactly.
Yeah, and then there are some funds out there that are solely focused on holding the loans in their fund, and their funds restrict them from levering the fund. So there is a degree of that, but I think everybody's reserving the right to either sell the loan or put it into a CLO.
Yeah, and exactly. Like selling it doesn't necessarily mean CLO. It could mean selling it to another credit. And so I think what you're seeing also right now is the fact that there's now more liquidity in buying those pieces of the loan, those tranches of the loan, is now making the spreads be a little bit more competitive because there's now people on the other side or on the back end that's willing to buy it.
Right. There's that. And the other thing that's driving pricing is the back leverage that's being offered by the banks. So if you're looking at how a lot of these debt funds operate, they either have some sort of a warehouse line or that they put these loans on to ultimately deliver them to a CLO, or they are financing each loan with note-on-note financing from the banks. And what we've seen is the banks having a strong appetite for that because it is incredibly low leverage relative to the actual underlying asset. And it's also a way for banks to put out large amounts of money, albeit at much lower yields.
Yeah, without having to like go out and originate themselves.
And then that kind of gets into the bank regulation. So since the GFC, you had Dodd-Frank come into effect. You've now had, I think, kind of the full force of Basel III come into effect, which are banking regulations that require certain amounts of capital being held for each loan and certain capital requirements for the banks. And what it's done is it's caused the cost of operating or cost of lending to banks to increase. So
because of the cash drag, basically.
Yeah, the cash drag, it's, you know, they have to hold, I think, under Dodd-Frank, Basel III, anywhere from 8 to 15%, depending on the risk rating of the loans for each loan. So you layer that on top of the fact that there's now a lot of regulatory compliance associated with making commercial real estate loans and other loans, but here we're talking specific to commercial real estate. So you have all this compliance, so you need a robust compliance team. So your cost of putting out every dollar, even though the bank's cost of capital is probably the cheapest across the board, it's gotten more expensive. And you layer that against an unregulated debt fund or a private equity shop that can set up a fund.
Wait, let me back up. So
Yeah.
those regulations are just with banks?
Banks.
Okay,
Regulated.
so like a debt fund doesn't have to comply with the same type of...
Yeah, they don't have the same oversight. So they're not a regulated
Which is
bank.
why like a debt fund can potentially be more competitive than a bank. Is that why? Or?
Yeah, I mean, the thing is there isn't, whether a debt fund makes a 50% LTC loan or a 80% LTC loan, there isn't a regulatory body that says you need to keep X amount of capital behind this loan to kind of shore up your balance sheet or to backstop your balance sheet. When you make a loan like that at a bank, you have, all kinds of regulatory bodies like the OCC that say, well, depending on how this loan is rated, you have to set aside a certain amount of capital.
Yeah.
And so that's one of the big difference. And so this idea, that post and the idea that private credit is being driven largely by banking regulation actually came from, I think, a podcast I was watching with Scott Bessent, Treasury Secretary. And he said that, and I said, this is really interesting, but he didn't elaborate. So I did a bit of research on it, and it turns out that there's a significant cost differential between the two. And it's really these regulations that are driving a need for private capital, private credit in the market. And so we're seeing that in today's market.
Nice. So which podcast was it? Was it the All In one that he was talking, or?
Yes.
Yeah. That was a good one.
That was a good one. Yeah, for sure. So I did a bunch of research, and I think what ultimately came out of my research is that for just commercial real estate loans in general, the bank's cost relative to, say, a debt fund or private credit is probably somewhere between 1.5 to 2x what it costs a debt fund to put out dollars. And that changes.
So is that regulation now changing where they're trying to even the playing field, I
think there's talk about it. I don't think there's any change to regulation yet.
But the idea is that that's why private credit is so attractive, is because they just have less regulations to abide by.
Yeah, and the risk rating that are assigned to each of the loans, like the risk rating that would be assigned to, say, like a 75% LTC loan today is considered pretty risky at a bank. So they're gonna have to set aside quite a bit of capital against that loan, which makes it more expensive, and then they're having to re-rate the loans every quarter. So it's an expensive endeavor. Whereas if you're going and making back leverage to a debt fund and your relative dollar is, 30 to 50% of the underlying collateral of the loan, I think, that's a much easier position for a bank right now. So you've seen a lot of growth in that space.
Yeah. So I guess with Arcus, you guys also have different products than just, the typical agency that I think you guys have a partnership with Lument on.
Yeah.
And we've, in the past have done many types of balance sheet type programs, bridge the agency. What do you guys have offering right now, and how are you guys getting competitive in the mix? I'm assuming you guys are also kind of abiding or have to abide by these regulations as well as a bank, or
no.
Are you considered like a debt fund of some sort?
We're an advisory firm, and Lument and Oryx are a financial services firm. So if you take a step back, we engaged in a long-term exclusive correspondent agreement with Lument and their parent company, Oryx. Oryx is a Japanese financial services company, probably about $125 billion of assets, $30 billion market cap, plus or minus, traded in Japan and on the NASDAQ here in the US. We struck that agreement with them that allows us access to their agency licenses, so Fannie, Freddie, FHA, as well as their balance sheet. And in addition to that, we also have the ability to go out to the broader capital markets. So debt funds, CMBS banks.
So exclusivity with those sources of capital, but then can also, as an advisory firm, originate different other types of capital.
Yep. So we I would say we have kind of two verticals. We have our multifamily finance vertical, which is largely Oryx and Lument's balance sheet, Fannie, Freddie, and FHA. And then we have our debt and structured finance vertical, which is everything else, multifamily, non-multi, self-storage. We looked at some office deals. We've looked at some retail, and that will run the gamut: Lifeco, bank, CMBS, debt fund. So we're really focused on really being able to provide capital for any of our clients in any scenario.
All parts of the stack, or mainly credit?
Credit, we are doing. We're looking at pref equity opportunities. A lot of pref equity opportunities. Yep. A lot of mezz. I think envision in the future being able to go out and pitch like JV equity for our clients, but I think that's
a little tough right now.
It's a little tough right now. There's not a lot of demand for it. But we're I think that's maybe Arcus V2 and towards the end of year 2 or year 3, I think we'll start to try and build that out.
Nice. So I guess this is a good time, like, the Arcus name, why the rebrand? Give me a little bit of idea of like what, the past almost 20 years that you've been working as a team, what's different now with Arcus and why the decision to rebrand?
Yeah. So I'll kind of back up. So our background, the 4 principals of Arcus Harbor, Greg, Kristen, Tina, and myself, started at Deutsche Bank and the predecessor companies to the business unit at Deutsche Bank that we were in. Greg, Kristen, and I left in 2011 to start the West Coast operation for Beach Street, which you remember.
Yep.
Tina joined us at Beach Street, I think in 2012 or 2013. She was on the kind of credit risk and underwriting side. And fast forward to 2013, we had built Beach Street to about a $13 billion book of loans and sold that company to Capital One. And over the next kind of 2 years, we integrated Beach Street into Capital One's commercial banking platform and ultimately became their agency and commercial real estate group. Mm-hmm. We had a great run, about 10 years. 10-year run with Capital One. We did a lot of deals together.
Good times.
Did a lot of agency together. We did a lot of balance sheet. But one of the things that really came up over the last 3 to 5 years is our clients started asking, hey, what other capital sources, what other products do you have besides Capital One's balance sheet? And the agencies? And what we found is that it was very difficult to pick up the phone and call a debt fund or call a Lifeco from a bank, because everybody's first reaction is, why aren't you guys doing it? And it's a tough sell. You're starting, kind of from your back foot. You're selling, hey, we're not trying to offload deals that we don't want to do. It's just not a good fit for us.
You have the relationships. They're coming to you with, wanting advice of some sort or some sort of like alternative capital. And you see there's a demand, but there's no need that's filling it. Or at least that you can provide.
And so I think, we had a great run with Capital One, but we kind of thought last year it was time. And we spent a lot of time thinking about the next step and what we wanted to do. And whether it's go to another mortgage banking shop that's maybe an unregulated shop. And we came up with the idea of, hey, is there a way we could do this on our own, start our own company, but still have, some sort of direct access to the agencies and
key.
A balance sheet?
That's key.
And frankly, we pitched the idea to a number of places, and a number of places were like, yeah, no, you either come and work for us or you don't.
Right.
And then a couple of groups, were very interested. They liked the idea of, revenue sharing and really having a partnership. And we ultimately settled on an agreement with Lument. It's a long-term exclusive correspondent agreement. It gives us the direct access to capital through the agencies. It gives us access to Lument and Oryx's balance sheet. And also allows us to go and clear the capital markets for our clients, which was the primary focus.
It's really like a one-stop shop, at least on the credit side, right?
That's exactly it. And I think the philosophy behind what we were trying to do is, when you get when you're at a large organization, there are a lot of stakeholders, right? If it's publicly traded, there's shareholders. If it's privately held, there's still the shareholders or the owners of the company. You have your clients, you have all of the other people involved in the business. And when you have a small, very nimble entrepreneurial company, you can say, yes, all that stuff is important, but the number one thing for us is our clients.
Yeah.
And putting clients back at the top of the list. And when you get into some of these larger organizations, the clients, you tend to forget that the clients are why your business exists. And so that the clients start to fall down the list of priorities. And we wanted to be at a place where commercial real estate and multifamily was a top priority, and we could put the clients at the top of the list.
Yeah.
And so that's the philosophy behind Arcus, and that's what we're trying to do, and that's what we're building.
Yeah, I mean, that's definitely the experience we've had with you guys. You guys were always, you guys were always
that.
Like person to person. How can we help you? Rather than just what deals you have, this, that. It was very much like, how can I help you in anything? And it was a very friendship first of some sort through business.
It's important to work with people that you enjoy working with. Like,
100%.
Our business is, it can be tough. And so if you're going to work through challenging issues, why not work with people that you like? And for us, I think we also set up the company so that we have a seamless team. So our entire team has been with us a minimum of 5 years. So we have Phil Cobb and Raquel Bashaya, who have been with us for, call it about 5 years, maybe a little over 5 years. And you have Celeste White, who runs all of our transactions and due diligence. You've worked with her before.
Yeah.
She's been with us for, 10, 12 years. And Allie, our operations manager, has also been with us upwards of 5 years. And then, the story with Greg, Kristen, Tina, and myself. We've been together 20 years. Our big pitch is we have 90 years of combined experience.
You guys combining the experience. Yes, exactly.
90 years of combined experience. And we, the way that we're set up is, when you work with us, you don't just get, Greg or Kristen or Tina working on your deal. You get our whole team.
Mm-hmm.
You get, Greg, Kristen, Tina, and I giving different perspectives. And also, if when we're really busy or somebody's, out on vacation or doing stuff for their kids, like you have just this team that's somebody's always on and always there. And so we think it's a little bit different of an approach. And so far it's worked. We're, I think 15 deals in. So we're 12 months in. We started in June 2024. We're 15 deals in, about 550 million closed, with another, I would say we've got in various stages about $1.5 billion in the pipeline that we're looking at or either processing. So it's
and how much of that is like traditional agency versus kind of alternative programs at this point?
I would say right now, based on what's in the pipeline, active in the pipeline, like we're working through currently under application or term sheet and closed, I would say we're probably, 2/3, 1/3 split. 2/3 of it is agency.
Yep.
And 1/3 of it is balance sheet. And of that kind of balance sheet bridge, we've got, I think, 3 deals that went to Lumen's balance sheet. And then we've got another 5 that are with debt funds or other capital sources.
Yeah. So I want to keep like cutting up the pie a bit, because I think it's telling, right? Of like what, like a shop like yours has access to different types of credit, what you're busy with. So 2/3 agency, 1/3 alternative, I guess.
Yep.
Out of the 2/3, how much of that is acquisitions? Ballpark. How much of that is like refis, painful cash in refis or something? Like,
let's see.
I think it's a good litmus test, right? Of kind of like where we're at in the market. And so
I would say, just off the top of my head, it's probably 20% acquisitions.
Mm-hmm.
But we're seeing that start to pick up. We're looking at a lot more acquisitions. But it's still heavily skewed towards either refinances, just, maturities, like loan maturities, agency loan maturities needing
agency loan, like an agency floater. Or
an agency fixed.
Like we 2025 year, like
2025 year.
Dude, we're already 5 years after 2020. Actually, that's crazy.
They weren't really doing much 5-year in 2020, so it's really like either old 10-year fixed loans or 7-year fixed from 2018.
Okay.
So there's a decent amount of that. There's
cash in. I guess, sorry to cut you off. Like in 2018, from what I remember, rates were like at a low. Yeah. Oh, yeah. Everyone's like, oh, let's refi. Like it's low. It's not going to get lower than this. Yeah. And then COVID hit and it went lower. And it's like, oh shit.
Yeah.
So I guess it makes sense. You probably have a lot of maturities.
You had that run up towards the end of 2018.
Yeah.
But yeah, there's maturities. So there's a few of those.
Okay.
So that's somebody that has to transact.
Yeah. And I guess those aren't, I mean, you tell me like there's those ones from 2018 aren't like cash ins, right? Like there's been so much rent growth.
Those are generally, I would say the profile of those are generally either a fund or a family office that's held those assets for decades upon decades and generations. So this is probably their 6th or 8th refi since they've bought or built the asset.
So you have a few of those.
We have some floaters, agency floaters that are just their cash flows being consumed by, rate cap escrows. Mm-hmm. And so we've had some cash neutral ones. We've had a few cash in or pseudo cash in where the rate cap escrow is the cash going back into the deal to kind of fund the difference. So it's not like the sponsors are having to come out of pocket or issue a capital call. And then I would say that's the majority of it on the agency side. And I will say what we're seeing is if somebody doesn't have a gun to their head today or a real reason to transact, I think a lot of people I want to get into position to transact, but I want to kind of wait and see and watch the market, what happens with what's going on in, the US economy, US politics, geopolitical things that are going on all over the world, tariffs, all you name it. There's all kinds of forces that are pulling the market in different directions. And so I think we do have a lot of clients that if they don't have a reason that they need to transact today, they're like, let's tee this up and get it into position. Yeah. And if we see a window in the market, we'll pull the trigger.
And I think anecdotally, I feel like this year there's a little bit less of kicking the can than there was in the past couple of years, right? There was a clear motivation to kick the can when we were in 2023, 2024, survived to 25, all that. Yeah. I think like now we're in 25 and if you already made your capital calls or put your pref on it to give yourselves a couple years, here you are now. It's hard to justify putting more capital again into the deal after doing that once or twice.
Right.
And so I'm at least starting to see less of that and more sellers capitulating, deals getting done. That's why I was kind of picking your brain on like your split of deal flow.
Yep.
Because I think you're seeing a little bit of a shift, but it sounds like you have a few of those still.
Yeah.
And maybe they have their reasons. There's still uncertainty. That makes sense. I guess, what have you been seeing? Is that match up to what you're seeing or how would you?
I think what we're seeing, particularly on the acquisition front, to your point, sellers capitulating, I think there's a couple of camps. One are guys that maybe, made a bunch of money, they bought right in maybe like 2015 or maybe even before that. And they missed the mark. They could have sold in 2022 for, a big number, or 21 for a big number, but they're still like, okay, I'm out of basis or I have some reason that I want to transact, take some chips off the table or 1031 into something at today's basis. Cause I think there are
they feel it's the bottom right now.
Yeah, there's some opportunities. Then there's some acquisitions or transactions that are occurring where I think you have your merchant builders that want to sell and they're still their basis is still below today's replacement cost. So you're seeing them say, well, I didn't get the number that I was performing, but I'm happy to,
not take a loss.
I'm a merchant builder. Like I'm not set up to hold and operate this thing. So I need to sell. And so you're
capitalize their next development.
And so you're seeing that. And then you're also seeing sellers truly capitulate, either, getting out unscathed, didn't make any money, but didn't lose anything, or maybe taking a little bit of a loss, or not making as much money as they maybe thought they were going to make, or they had pro forma'd. And so on the flip side, the guys that are buying and the guys that we're financing, we're seeing these assets trade, and we're financing these assets at a great basis, right? You're seeing deals trade at well below today's replacement cost, anywhere from 10 to 30% below replacement cost, which is, it's a great deal. And
I've seen some deeper, honestly.
I'm sure.
There's like
you're looking at a lot more than we are.
Well, yeah, in Sunbelt for sure, it's like around that 30% maybe, where it's like easier to build. And I think where it's harder to build, you're still seeing like those really deep discounts to replacement costs. And kind of like what you're saying, sellers are meeting the market because they're in it for less than what it costs today to build.
And the interesting thing is the math on some of that stuff works really well, because there's still strong demand for apartments. So you're not, where you're seeing impacts to cash flows, the usual suspects, insurance, labor costs.
Still maybe some short-term struggles of like maybe like low 90s occupancy instead of mid 90s, or like 3% bad debt instead of 1%.
And concessions, that's market by market.
But
too.
I think exactly. But I agree with you. I think like taking a step back, it's still a good bet because there's still a housing crisis nationally. Some places worse than others, and people need a place to live.
Yeah, I completely agree. So we're seeing that. And then we're seeing, on the acquisition front, I think that kind of covers the acquisitions. We're seeing, some good opportunistic buys. And we've seen some interesting deals where the cap rate is, you're back to positive operating leverage. You're financing at, low to mid fives, and you're buying at a true 5 3/4, 6 cap, or even north of that, depending on the market that you're in. And so that's I think promising to see.
It's so funny. I had like a different pod where we were kind of debating, because like you're saying low to mid 5, but that's after the buy down. It's like, okay, now you're tricking yourself. There's that, like, you know what? I think the idea is, the buy down, however you want to justify it, is towards the basis, and you're borrowing at a lower coupon than what your deal is yielding at. And I think the bottom line too is, you haven't seen yields like this in a long time.
Right.
And since I've been in the market, we've been operating in such a long bull run that you always had to justify some sort of negative leverage, because there was growth and there was, solving to a yield on cost rather than in-place metrics.
Yeah.
And that's changed now.
Yeah. It's definitely interesting. I think some of the buyers that we're seeing right now are kind of old school syndicators. So still syndicators, but old school syndicators that buy, don't ever sell, and look for long-term value growth. And in the short term, they're looking at what does the cash on cash look like? What can I pay my investors?
I want to unpack that a little more, because like old school syndicators, these are guys who are using the tax incentives that real estate has and finding ways to create cash flow, which is like not what usually syndicators think about. They think about IRRs, promotes, things like that. But these old school ones are like, all right,
that's the modern day syndicator.
Yeah, exactly. The old school ones are like cash flow, 10 and 1031 eligibility into the next deal, and just ride it, keep deferring the taxes, keep getting cash flow. I think that's a great structure to be in this time right now, where long term it's going to be good, and you might have to bite the bullet a bit with short term struggles operationally, but long term, like this could be a good buy.
Yeah, for guys like that, positive operating leverage is what you need to make your business model work. And I think we're starting to see that. So that's it's promising. And then if going back to, I'm going to shift back to our the other part of our conversation, where we're still seeing cash in refinances. I think we've seen people say, let's hold and see what happens with the market. And I think we're seeing operators and sponsors come back to us and say, okay, well, we've called capital. We're ready to refinance, take out the step fund loan that we originated back in 2021 or 2022, and take their kind of 3 to 5 year hold and recast it and look at it more of like a 7 to 10 year hold.
Yeah.
And, put 5-year fixed rate debt, pay down the existing debt, and kind of take a look for the long run. And I think those are guys that probably bought right, but over levered, took advantage of the leverage that was available at the time.
And bought right in terms of, it's a good long-term strategy, but you need more runway.
Yeah. Yeah. You need more rent growth.
Yeah.
You've had forces working against you. You've had interest rates run up. You've had insurance costs double, triple, and that's probably on the low end.
Yeah. Especially in Florida.
Yeah, especially in Florida. I mean, Florida, I've heard,
and California too.
Yeah. I mean, I've heard nightmares of, 6, 8, 9 times growth in insurance cost. And
what you're seeing now is actually when we're starting to see renewals come down. And so if you kind of made deals pencil a couple of years ago, you're getting some upside just from renewals coming inside. It's actually, I always compare insurance market to like a lending market in instant, because just as we were talking about like CLO and selling a piece, selling a tranche, like that's how insurance works. It's selling a tranche, selling a piece of the TIV that's insured and selling that off. And the reinsurance market was not only, are we dealing with natural disasters becoming more frequently, but reinsurance markets froze.
Yeah.
Just as the lending market kind of froze.
I mean, so if we're being honest, I think there was a severe misprice in insurance for quite a while. Assuming the 200 to 300 per unit per year was probably, we were all very lucky at that time. And I think
because there was a lot of liquidity, right?
There was a lot of liquidity.
How it was.
And so it was mispriced. And then we had a series of natural disasters that caused massive payouts and going all the way down to the reinsurers. And so I think that
going all the way to the the Fed, right? Bailing out the insurance.
Anyway, so we've seen, it's interesting because you've seen top line growth, a lot of top line growth, but you've seen that eaten up by insurance, labor costs, interest costs. And so it's definitely been challenging for a lot of our sponsors. And, guys will pick up the phone and call us and be like, look, we grew income by this much. And they're like, why doesn't the loan pencil? You're like, well, there's the expense problem.
It's the operators that performed operationally, they still do have more choices than the ones who didn't, right? Which is why you're saying like cash in, people are able to do the cash in and actually get equity or some sort of alternative capital to get more time because they performed. The ones that don't have that chance. They don't have that selection. They have to sell at a loss. They have to capitulate.
If you can look at the numbers and look yourself in the mirror and say, our basis is X, today's market is Y, and we can get back to X, or we can exceed X. I think, that's a conversation that, a lot of sponsors are having to look at. Did I buy right or did I overbuy and then over leverage? And is it time to cut bait or is it, can this be salvaged with an extra 3 to 5 years of term?
So I guess, one thing I want to ask is, as you're seeing operators start to make that decision, right? What's like your advice to them? What are some good litmus tests for making that sound decision of whether to cut bait or to move forward? What are some of the products you're seeing that it's like you should consider? Like, what's your advice as they're kind of making this decision? Because this is the year that people are making that decision. So.
They're definitely tough decisions. I think I go back to there is a lot of capital out there and available. And I think, engaging with or working with somebody or a group that can provide a lot of perspective and really, really, truly clear the market and give you an answer of, is there something out there? Is there a product out there that can help, solve the short-term problem that we have? And, I being very candid, there are a lot of, phone calls that we take and we have that are like this. Unfortunately, the basis in the deal is it's going to take a long time to recoup
be the
that
bearer
basis.
of not bad news. Yeah.
But I also think that sometimes nobody's had that conversation, either in the organization or, outside of the organization. And so I think, really taking the time to look at the deal. It's not like the heydays of, 2021, 2022, where it's like send a pro forma and a T12 and a rent roll and, we'll get an answer for you. It's like we're
lending based on, sponsor pro forma numbers.
As you're seeing, everything is it's taking more time. It's more difficult. You need to really get into the weeds. Even, as an advisor, we need a ton of information to be able to assess the situation and then look at, okay, here are the different options. Yep. And I mean, in some cases, sponsors are coming to us 90 days before they even execute a term sheet, because we're first just analyzing the deal at the Arcus Harbor, and Lumen level.
Right.
And then we're saying, okay, here's what we think we should do. Here's the strategy. Let's go to the market. Let's go look at, agency loans plus a slug of mezz or pref. And let's go to the debt fund market. And when you go to the debt fund market, you're talking about like 40 to 50 shops sending a package out. And, gone are the days that, a debt fund will take a sponsor pro forma and, a one pager. It's like, we're putting together very robust analysis, looking at different options, forecasting cash flows and really looking at, does this make sense? And how do we make this make sense for someone that's going to lend on this? And so it takes a lot of time. And a lot of times that can be a 60 to 90 day process just to get to, okay, here's like, we've narrowed it down from, 50 to 60 options. We've narrowed it down to 3. And here's the best options to go through.
Yeah. And it's also when you're narrowing down those options, one thing I've learned through this cycle is don't just go with the cheapest rate and the devil's really in the details of like how do they, what are they doing when they originate the loan? Are they selling the APs? Are they CLOing it? Are they selling it to there? Like, who's the decision maker? Are they keeping it on the balance sheet? Will they work with you? Like, relationship is so key. And
very much so.
I really learned that through this cycle that you can't just pick the lowest rate. So I guess my question to you too is like, are you guys kind of vetting that in the same way? Like, hey, here's one option that's the cheapest, but hey, like you might want to just pay a little bit more and work with this group.
Yeah. I mean, I think a big portion of that is figuring out what each shop has a different process.
Yeah.
So my background in, balance sheet lending with Capital One and agency lending, we understood those processes very, very well. And now if we're going out to 50, 60 different, capital sources, understanding what their process is. Yep. I mean, some guys will issue a term sheet, no problem, but that term sheet hasn't been blessed by the CIO or credit committee or investment committee.
It's just worth whatever it's on paper.
Yeah. It's literally just terms on a paper that they're willing to go and put in front of their investment committee.
And leave you at the altar.
Other guys are, going to investment committee or, their CIO is reviewing the deal before they even issue a term sheet. And so just understanding that. And I'm not saying one way is right, one way is wrong, but if you understand that, then you know what you're dealing with. And you probably don't want to make a full-fledged, decision on, one of your assets based on a term sheet that's not fully vetted. And so I think that's taking your time and making sure you allocate ample time, because I think from start to finish, you could be looking at 90 to 120 days from the time that you say, "Hey, Andrew, let's start taking a look at this deal. Here's our pro forma. Here's the rent roll, T12. All the different information that you need." It could take quite a bit of time to narrow down to those final ones, and not everything is what it seems too. There's a lot of nuances that may not have been important in 2021, 2022 that today are very important. Like one of the SOFR floors. Yeah. Like if you're of the opinion that the Fed's going to start to cut later this year, and it's going to be successive over the next, 12, 18, 24 months, and you're going to get into a floating rate loan and you have a, 3.5% SOFR floor, like that's probably not something that you want to negotiate. Yeah. That's a devil's in the detail, but there are pricing implications, especially if somebody's looking to CLO that. There are pricing implications to having a lower SOFR floor. Right. So, it's like those little details where, everybody's looking at proceeds, spread, and, those are very important aspects of it, but there's a lot of minutia.
It's interesting because when you probably run that through a model with the projected curve, it's kind of stabilizing around 3.5. So you don't really think of it as like on paper is going to really affect the numbers, but you got to see through it, and the curve is never right. And so you need to be on top of that little minutia for sure.
Yeah. Yeah. And even things like, if you're doing a floating rate deal right now and you have the lender's requiring an interest rate cap, looking at what that strike is and whether or not they're comfortable with you buying a 2-year cap up front versus 3, because that could be a difference between 20 bips of your loan amount versus 75 bips. So it's a meaningful number, especially if you're doing bridge to bridge right now.
Yeah,
right?
What I've learned too though is that might help on paper a bit, but downside protecting and just getting even if the lender requires less and just getting more. I think that was something that I've kind of learned through this is just because the lender is letting you pay a little bit less of the cap, maybe it's not the best idea. Maybe get a cap that is the same term as the maturity of the loan. You can always sell the cap after you sell the deal. There's little things like that that you always think the lender might have more stringent requirements than an owner, just going with agencies, things like that. There's always, but sometimes with these debt funds, they also just want to get the deal done. And it's hey, let's take a step back. Let's maybe just, instead of what looks the best on paper, a couple of bips here and there. Yeah. Let's,
and there's all kinds of different strategies. If you get on the phone with one of the Chatham guys, sure, can they get you a 2-year cap or a 3-year cap or a 5-year cap, whatever you want? Mm-hmm. Sure. But they do all kinds of really interesting stuff where you can almost ladder a cap, similar to the way that somebody that's investing cash. Cap. Yeah, where you basically you can buy
different strikes at different
years, different durations. Yeah. So if you're of the opinion that interest rates are going down, maybe you buy a 3-year cap, but you buy a 4% strike this year and a 3.5% strike second year and a 3% strike the third year,
which would be cheaper in the second year, assuming that rates go down.
And so they can do all kinds of interesting things. So there's all kinds of little nuances. Yeah,
that's why we need you.
That's my advice. Is you need today more than ever. You need somebody that's in the market every day, that's looking at all these different structures. We're reviewing tens, sometimes hundreds of term sheets or, sets of terms from different lenders. And so we're seeing everything that lenders are putting out there and creative ways that they're looking to maybe, either juice the spread or change the risk profile for them for a CLO and maybe have it trade a little bit better. So we're seeing all the different tricks, tricks of the trade, so to speak. And I think you need all of that along with, a wide range of perspective.
Yeah, especially, as operators, we're so entrenched in the market and the deals sometimes we don't know some of these little things that, as you said, the devil's in the details. So
yeah.
Well, Kwok, it was really great having you on.
Yeah, thank you so much. This was fun, man.
Is Arcus still doing some golf, shotgun starts, any of that? What do we got going on?
We are endeavoring to bring back Pelican Hill.
There we go.
Arcus Harbor.
Oh, we had a good
Arcus
time
Harbor
together.
edition. Oh,
I don't remember much of it because you got me blackout. But you know what?
Tequila will do that.
Yeah, exactly. So
but,
it was great.
Anytime you want to come down, we can go play golf, man.
Okay, awesome.
I'm terrible at golf.
Awesome.
But,
yeah,
I'm good at drinking.
Exactly. That's why I was so good. So awesome.
But, well, this is great.
Great having you on.
Yeah. Thanks, man.